Hello, I'm Rika Eka from Unquote. And joining me today is Ben Holmes, a partner at Index Ventures. And we're going to take a closer look at what happened to venture in 2009 and some predictions for 2010. Thank you very much for joining me, Ben.
Thank you for having me.
And despite predictions at the onset of this crisis that venture activity would blossom in a downturn, that we'd see an increase in activity, we actually saw the opposite, with LPs even being slightly more cautious of the risky venture investments. How would you explain this?
Yeah, I think to understand the last couple of years, you probably have to go wind the clock back a decade and think what happened following the dot-com boom. Essentially, there were a lot of funds coming out of the end of the dot-com boom on the venture side, which didn't perform that well, unsurprisingly perhaps. And at the same time, in the following 7 to 8 years, a lot of the other asset classes, listed stocks, property, buyouts, hedge funds, were showing very good performance. So there was a period when it was quite hard for venture to make a case. Now, clearly, we know now with what happened with Lehman's and the subsequent events that a lot of the risk factors inherent in all those other asset classes had been grossly misunderstood. So by comparison, venture had been treated slightly unfairly. And I think in venture, we have a fairly simple business model. We don't rely on access to cheap capital in the way the buyouts do. We don't rely on the financial chicanery that you see in hedge funds. We just try and provide the equity financing to turn good ideas into great businesses. It's simple. So I would make a case that venture always should be a great asset class to invest in. And I think particularly given the tarnished reputation that came for some of the other asset classes at the time, I think venture should have done well. For various reasons, as we know, it hasn't done well.
And another trend that we've seen when we recorded venture deals at Unquote is that venture capitalists seem to be more risk averse now, and sort of they're moving towards more later early stage investments, sort of in more mature companies.
Yeah, I think that has been a trend, and to an extent, Index is part of that. What we did was we established a 400 million euro growth fund a couple of years ago, a dedicated fund to go after growth equity investment opportunities. And our thinking at the time was we'd seen lots of entrepreneurs with pretty interesting businesses that, because of the relatively weak IPO markets and exit markets, which had persisted for some time, were often having to sell their businesses too early and for suboptimal financial outcomes. So we essentially established our growth fund to try and help entrepreneurs who found themselves in that situation. Rather than selling, they would get the support and finance they needed to shoot for a much larger exit. But I agree with what you're alluding to. A lot of the venture firms actually sort of skewed their focus upwards to larger, slightly later, what they thought would be less risky deals. And I think that was probably driven by a couple of things. First, I think there's a lot of venture firms out there that do need to bolster their track records. And I think they see getting involved in some later stage deals, which will hopefully exit in 1 to 2 years' time, is a quick way to chalk up some wins. And then I think the other perception is that growth equity, or in the growth equity area, it's much easier to deploy a lot of capital quickly without the hassle of having to do lots of small deals. And I actually think both perceptions are wrong. Firstly, the growth equity business is pretty hard. Finding the right companies and then persuading the entrepreneurs to open up the cap table and let you become partners in their business is quite tough.
It's essentially businesses that are already quite promising and going well. So
yeah, exactly. I mean, I think that there's been a tendency in Europe for as I mentioned, for businesses to sell out at the 200, 300, 400 million valuation, which is often a great outcome for the entrepreneur. But it does mean that there have been fewer billion-dollar exits coming out of Europe versus the US in the venture community, where you've had a catalogue of billion-dollar exits over the last 20, 30 years. So that's really the aim of the growth fund. And as I say, it's tough doing the deals and getting the entrepreneurs on side. And so I'm surprised in a way that so many venture firms have now moved into that category. And I'm also surprised, frankly, that so many are abandoning venture at such an exciting time for the industry.
And speaking of exciting times for the industry, we talked briefly earlier about the sectors that you were sort of expecting to do well in 2010.
Yeah, I think I can't remember ever at the beginning of a year looking forwards and seeing so many different industries and sectors which are at the cusp of disruption. And it's obviously where there's a market dislocation of some sort, or where there's actually a company that's driving disruptions, whether it's a Skype or a Betfair, that you get the best returns. And I could get excited about opportunities in entertainment, retail, financial services. I think if I were to highlight one, it would probably be mobile. I think, let's face it, it's not been a great sector for VC the last 15, 20 years. But I think now there is real disruption happening. Clearly you've got Apple, which has established an early lead in the smartphone category. They will want to maintain that position as the smartphone category expands. You've got Google, who want to extend the dominance they have in web advertising, but they need to preserve that as people increasingly browse the internet from mobile devices and access the internet on mobile devices. You've got operators who are casting around for some sort of raison d'etre, and they will need to somehow have some story for their shareholders. So I think what that will mean is lots of acquisitions, both of the existing VC portfolio companies, and also I think in this new ecosystem there will be a lot of opportunities for exciting new companies.
Index Ventures ended 2009 on a high with a Playfish exit, the game developer that was sold to Electronic Arts. Are you now an optimist for 2010?
Yeah, certainly. I mean, firstly on the Playfish exit, they were a fantastic team to be involved with, and it was both a pleasure and an education, frankly. And I think a lot of the smart approaches which they pioneered in the game sector will definitely be relevant to various of the other categories and sectors where we invest. So, I mean, yes, it was a good financial return for us. I won't tell you exactly what, but it was a good one. But for me, more importantly, it was just an incredibly valuable experience. So we definitely hope we'll have more like that. And I think looking at 2010, as I mentioned, I think we definitely, there's a lot of technological change going on, and that tends to be where the big winners are kind of created and the big industries topple. And I think a lot of that will actually play out in 2010. But also, I'm very optimistic for the following decade. I think venture capital can have some great success and start to make up some ground on buyout and hedge fund and some of the other asset classes.
Thank you very much.
Thank you.
That was Ben Holmes from Index Venture, ending on a very positive note for Venture in 2010. I'm Rika Echo from Unquote. Thank you for watching.